Hey YouTube, so in this current segment, we'll be talking about liquidity concepts and how understanding this will help traders to improve the trading setups and all that. Liquidity is what drives the market to move as a whole, and without the liquidity, there's no way that we can get beautiful trades set up come. For example, you're on a road trip to your destination, right? At some point of time, you will need to take a break. Your car needs to pump gas, fill up to be able to continue your journey again. So when it comes to market, it is the same. You will not move from one level to another level all the way. At a certain point of time, markets, instead of moving one straight point, you will form a higher high or lower high, a series of high high, high low, or a series of lower low, lower high to slowly get to its destination. And over time, through this journey, liquidity will be taken before price will go where it intends to go in the future. Hence, liquidity acts as basic fuel to markets as a result. So of course, the basic definition to this is that liquidity is where most of the money is found in the market. So for example, of course, this is where most stop loss will be located, which usually occurs at the highs and lows. So take this for example, like let's say, hypothetically, if you want to enter a sell from here, correct, the most ideal thing to do is to put your stop loss above a high. And if you're entering a buy from here, from this zone, from this low, you'll probably put your stop loss at this behind this low. And likewise over here is the same thing, the same concept where you put your stop loss to cover the high. Hence, this is a reason why this is where there's an area of stop losses here on this high as well as on low. So what are some of the common types of liquidities that we'll be exploring today? So for the very basic ones, of course, will be the equal highs and the equal lows liquidity and the trendline liquidity, right? Because support resistance as well as supply demand, all these potentially acts as barriers to the market itself, right? Trend lines as well, it acts as slanted support and resistance. In the L2 side, which we'll be showing this more in depth in the chart later, it will be structural liquidity as well as your internal range liquidity, the equal highs and the equal lows liquidity, right? You can see that, of course, in these examples, where there's a series of equal high liquidity being formed when there's a resistance here or there's a supply getting respected at this point. Likewise over here as well, right? And because there's so much liquidity in this point here, when you take a sell here, price is likely to target these levels because there's a lot of money being present. So this is where price will likely go here. So once this liquidity has been taken, market has enough fuel, which will now go up. And now this new pool of liquidity here would have been targeted by this level here. So our sell side liquidity here has been taken up, our buy side liquidity has been taken up, and this is where markets, after eating this buy side liquidity, price can just go all the way wherever it needs to go eventually. So likewise here, it is the same thing as well, right? And with a series of buy side liquidity that's been present here, price from here, either sweep all of this liquidity that's been present before coming back here to sweep this sell side liquidity here before going where it needs to go again. Right? So this usually applies to equal highs or equal lows. With regards to trendline liquidity, it is basically, trend lines are basically slanted support and resistance or slanted demand and supplies. So basically, on a general uptrend, whenever you connect your trend lines accordingly to the highs, respective highs and the respective lows, there's some form of liquidity that's being formed below these lows and highs respectively, right? Because at the end of the day, when markets hit this level, there is this barrier here that's being present. So what markets can potentially do or will potentially do is that instead of reacting it accordingly here, price can just come here, briefly sweep this level before it comes up. Price can, of course, from this point here again, it can come and sweep this high before coming back down again. So likewise, on the downtrend, it is the same logic where, of course, along these swing highs, we draw a trend line. Along these swing lows, we draw a trend line. You can see that, like, because there's liquidity POIs here as well, right? There's liquidity pool being built at this level. Taking a sell here is not very ideal because you can easily get swept up, correct? Likewise, taking a buy here is not very ideal as well because a trendline liquidity can sweep you up before going where it needs to go. How structured liquidity works is that, of course, this can be there on a general trend to the upside where there's a constant break in the structure here. You can see that instead of forming a new high, it can break this previous low to form a new low. So what most traders might think is that, oh, this is a change in structure, change in character, right? So when price gets back to this level, there's a chance that traders might enter a sell from here, not knowing actually that this is a fake chalk, more of an inducement or structural liquidity to sweep this low out to continue the trend to the upside. So on a downtrend, it's the same thing where structure gets broken to the downside, where prices are continually forming new lows. And when this low broke this previous high, this could potentially be a change in character where potentially people might take a long from here, right? Thinking that structure may have shift. But in reality, this could just be inducement here to sweep all of this liquidity out, to take out all these early sellers before continuing the downtrend as a whole. So now with regards to the last type of liquidity, which is the internal range liquidity. So this comes as a form of understanding your internal and external structure very well, right? Where of course our black marking signifies the general swing structure, and our blue time frame indicates the internal structure. So as you can see, this is on a general uptrend as a whole, right? Because a higher high, a new swing high is being formed at each time, and a new swing low is being formed. So how internal range liquidity works is that on a retracement of the ongoing trend, means after the new swing high has been formed, when price is retracing back, so what markets will do is that you will look for all these, you will hunt all this internal range liquidity, number one. Number two, so when the last point of internal range liquidity has been taken out, this is where you can proceed to go long accordingly, right? So on another case scenario here as well, we can see that, right, this is where again, when price breaks this structure to the downside, internal structure has shifted to the downside, these internal range liquidities are getting target within this swing range. So once this swing range has been taken out, the internal range liquidity has been captured. This is where we can enter and buy again accordingly to continue our ongoing trend. Correct? So likewise for here is the same thing as well. Our last point of internal range liquidity is at this level here. So this is why on this ongoing retracement, we will probably enter along from here after our last point of liquidity has been taken. Of course, because this is an ongoing uptrend, there's no way that right off this bat, when this last internal range liquidity has been captured, there's no way we will be shorting here because technically our structure overall is still bullish. We won't be taking a short here when this last point of liquidity within this leg has been captured. We won't be taking any sales here at this point when this last point of liquidity has been captured. Let's now look at trading view for our real trading examples. So for the L1 liquidity, we'll be looking at the equal highs liquidity where we can define. So over here, basically there was this equal high liquidity present. Next, of course, we have found another one here, right? There's all this equal high liquidity that's being present here. So when price came down here to sweep all this liquidity, it sort of came up again. Right, so this is where a buy entry will have been valid. Of course, right, let's look for it again. So we have some level of liquidity that's being present at this level here, right? So this, when this has been swept right here, there is some decent fuel for price to come up all the way till here at least, right? Then this is another one. After this became liquidity, there is this liquidity that's being present here as well. So over here is another one. We can see that there's equal low liquidity that's being present here, right? So we can see that after this liquidity has been tapped in, the price gave a huge bounce after this sell side liquidity was taken. And likewise here as well, right? We could have find like there's these levels right here as well that's being swept for price came back down again. So we have found another level of liquidity that's being present here, right? Because after all of this got swept here in this demand zone, price went all the way up again. Right, so this is another clear example that you can see, right, as we scroll back again. And this is another very clear example, right, of equal high liquidity that's right here, equal low liquidity that's right here when price swept all the way down. It even swept all the way this level here. So after a sweep of this liquidity, price went up all the way here, sweep this again, we feel some brief shots here before continuing its uptrend again. So yeah, like I have just briefly scrolled H4 very casually, and we did find ourselves a few examples already. So right now, we'll be looking through the rough trendline liquidity. Personally, I don't really trade trend lines because it's so easy to get swept. That's number one. Number two, there's many other configurations to consider because a trend line, there can only be, say, 1 to 2 taps, and then that's about it. It doesn't exactly get respected, but for the sake of our trendline traders in general, I'll just be going through this, right? So we have found one very clear trendline right at this point, right? So this from one swing to another swing, right? You can see that over here, even though price did reacted accordingly, but there's a sweat, there's a pure sweep here before price continued its way down again. So when price came back again to test these many levels, right? Price did have a short reaction before breaking it very smoothly, comfortably, right? So this is one trendline liquidity that we can take note of. So like the other trend line, maybe if it's a bit refined, no, this didn't get taken. This unfortunately didn't get taken. So let's just briefly draw from this current level here as well, like from this low to this current low as well. So we can see that, of course, when price did swap here, there's a brief break in the structure here. So liquidity got swept at this point before price did went up all the way, right? So where else can we look for? Like there's one more redeploy here, right? Because at this very zone, you can argue that there's a trendline liquidity right here because there's like multiple touches, multiple reaction. Then when price further develops itself, there is one point right here as well. So we can see that over here, there's a short sweep here at this point. So this is another trendline liquidity that's been present, right? So it's very difficult to determine like where you can like comfortably enter this, and your stop loss have to be a little bit far away. It's very hard to determine where exactly is a good stop loss to put. Hence, this is the reason why I don't really use trendline as a confidence, but it is more of just a gauge. Basically, our entry model is something like that. When there's a continuation of the trend, then suddenly there's a break to the downside, right? So this is the fake chop that was being present right here. Right? So this is basically your entry model, or rather like the fake chop that happened, like because this is your structured liquidity and this is an inducement. So a very strong case in point would have been at this current level here, right? Because on this H4 we can see that there's a thin break in the structure to the upside here. It briefly swept this level. So price went all the way here. So this is a quite a clean model that you can look for. We went long from here, right? And price just obliterated all the way to the supply zone. So this is one good example of a structured liquidity. Next, of course, we have one more, which is right over here as well, where there is a break in the structure here. Correct. So it's the same entry model where like price did broke the structure to the upside and it came down to sweep early buyers here, which is at this very point right here. Right, early buyers were getting swept up by this level before price actually went up all the way here. Right. Then likewise here is one more as well, where this is a form of a structured liquidity. Price did swap this low here before going past this point as well, right? So let's move on again for more indicators. So you can argue that this could be considered as a structured liquidity as well. So earlier I pointed that this is an equal low liquidity, but in the grand scheme of things, this is the entry model did sort of play out, right? Because ultimately, like the uptrend seems to be forming at this point, but it went down to sweep all of these levels before it came up. Right? All these liquidity technically got swept before price moved up all the way again. So we can consider this as a structured liquidity. So this is another level that we can see, right? Because there's a break in the structure over here. Then along this zone, there is a sweep at this level here, right? Before continuing its way down. Because even though technically there is a break to the upside, but ultimately the entire structure still broke to the downside as a whole to continue the downtrend here. So we can argue here as one as well, right? Because technically after this liquidity here got swept, the entry models is the same, right? Like this serves as an inducement for early buyers, and then markets just went all the way down to trap early buyers before having a bullish order flow and continuing its way to the upside as well. So many examples of structured liquidity, right? And there's one here as well, very clean sweep at this point because once this position has been swept up, a pin bar has been formed as well. That's another confidence. It signifies rejection. And then the sell just can carry on from here. This is a targeted low already at this point. Yep. So I have gone pretty far, but I hope that you guys get the point of like how structured liquidity works and how to spot it, right? So because this is very good for you to determine that does your current structure have is there liquidity present? And if there's liquidity present, like in this scenario, right, like you won't necessarily take a buy from here because it doesn't make sense, right? You'll instead wait for price to come all the way here before you take a trade to the upside because this is where there's structured liquidity present right here. I hope you guys have learned a bit. I'll be proceeding to the next one, which is internal range liquidity. When it comes to internal range liquidity, which is our last segment of example, we needed to be very sure of our external structure before we can look into our internal structure, where, of course, corresponding where, of course, since in this case scenario, external structure, which is the black, is currently bullish. Therefore, we needed to make sure that internal structure sort of aligns, right? So in one way, when the last point of internal range liquidity in the previous leg has been captured, then this is where we can potentially go long and cover the low, go long, cover this low, at this very point itself, right? This is generally an uptrend. So when price breaks down all the way here, when there's a break in the structure here, right, technically your internal range liquidity is this entire range here, right? So we could potentially look for sales along here as well, and even till this point. After this last point has been swept, then this is where we can start looking for longs again, right? And because technically the trend is on the upside as well, so and even after this last point of liquidity has been captured, we might not necessarily enter any sales right at this point. Maybe only after if there's an internal break in the structure and supply is holding, then this is where we will enter the trade. Even though like this, there's this internal range liquidity basically to target. But however, since by this point already, like there's a potential for trend to shift because technically this low didn't cover this high, right? This low didn't break this high. So this high came downstairs. So this could potentially be a strong high. This could potentially be a weak low. So this could potentially get targeted, which in this case it did. It eventually got targeted. Swept this liquidity out before price went up again. So this is another scenario, right? When swing structure did get respected as a result because structures were still very bullish as a whole. But the moment our demand here fails, the moment this demand here fails, there's a very real plausible chance for all of these internal range to get targeted, right? Because there's a lot of liquidity here that's been resting at this level, right? So once this last point of liquidity gets targeted, this is where potential longs can come in, right? We either can enter on a risk entry, cover the low, or we can do another thing, which is to wait for confirmation entry to come in before we go long accordingly, right? Which can be at this level here as well to cover this high. So because over here, technically is uptrend, right? We won't look at this level here. We won't look at this last point of liquidity because this is a big high. But instead, after this structure has broken this previous high, this is technically the last point of liquidity in this current leg. We can potentially argue that this is the last point of liquidity to target in this entire swing structure. But of course, since this is the current level, this is the low that takes out this high. Therefore, this is the liquidity that is more or less confirmed that will get taken out. But anything else below is unconfirmed since this structure is technically still a bullish one, right? So there's this internal range liquidity that's still being present at this point. So next, of course, when price gets to this level here, we can see that there's massive amount of liquidity that's being present. There's one liquidity here, there's another liquidity here. The last point of liquidity is at this level here, right? So because technically this is the low that breaks this high, right? Or you can argue that this is the low that broke this high. So of course, let's say if we do happen to get a short position from this level here, we can potentially go short, cover this low, and because technically it didn't sweep up immediately, right? Like price didn't sweep up immediately. So we do know that this is a potential internal range liquidity that can get targeted as well as here. So going short from this level after this sweep is still possible as well, right? Let's now examine why liquidity is so important in the first place. So for attack, since liquidity acts as fuel and magnet for markets to go to, this can allow us to set better target if we see buy side or sell side liquidity being present. This is especially so if there's equal high or equal low being present, or if that high or low is a weak one. Next, in the defending part, this prevents us from losing unnecessarily when there's liquidity available against our current entry, which the market could still go to. In scenario 1, when there's liquidity pool still present below, and if you are looking to go long, we might wait for that liquidity pool to get tapped in first. Likewise, when there's liquidity pool present above, when we are going short, we'll probably wait for that liquidity pool to get tagged in first before we'll look to go short. So ideally, we should wait for the liquidity to get swept before we look for any potential entries. So I'll end off today's session with a quote is that if you do not know where liquidity is at, you are basically the liquidity that market will take.